You're about to hear my conversation with Arup Datta, head of Mackenzie's Global Quantitative Equity Team. Today, we'll talk about the evolution of quant investing and why this approach is not a black box. We'll also get into the details of applying quant investing to international developed and emerging markets. And finally, how value as a style factor has held the team's attention in the United States since late 2025. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, podcast from Mackenzie Investments. My name is Rajan Benson, head of portfolio construction with Mackenzie. Today, I'm joined by Arup Datta, head of Mackenzie's Global Quantitative Equity Team. Arup, welcome to the podcast.
Thank you for having me, Rajan. Always a pleasure.
Arup, I'm going to go straight into my first question, and that is quant investing has been around for decades. I'm curious to hear from you. What's actually different about how we do quantitative investing today versus, say, it was 20 years ago?
So, as you know, I'm in my 34th year doing quant equity. I remember the days when I joined the business in 1992 at a very nascent business. People didn't know what quant was about, and we had to explain what quant was. Put forward the clock now, 33, 34 years, and I would say most people understand what quantitative investing is about. It's just a disciplined rendition of what a fundamental manager done. I don't think it's any different from that. We look at valuation of a stocks. Fundamental managers look at valuation of stocks. We look at the quality aspect of a stock, things like free cash flow margin. The fundamental manager does that. We look at the growth aspects of a stock. The difference is our use of computing power and new techniques, which has really, really blossomed in the last few years. I would say in my long career, the computing speed has always improved, but the rate of change of computing speeds or computing power, especially since GPU servers like NVIDIA's GPU servers came into existence, have really allowed us to do research in a reasonable amount of time, what would have taken crazy amounts of time in the past and almost make them in those days undoable. So the computing speed keeps getting faster and faster, a little bit exponential growth in that. And then it has been met with a lot of newer techniques today. I went to engineering school in India a long time back. I was taught all the latest techniques, but today where things are in terms of what people are calling artificial intelligence, or more specifically machine learning, reading text, NLP, I used to say in the past that reading text, financial statements, MD&A sections was off limit for quants. No longer the case. We go and read those texts using a computing program and make inferences from it. So I would say it's been really fun for me to see the last 6, 7 years, the evolution of quant, where a lot of what were ideas in the past, we are about able to execute them in real time and for our clients, which is the most fun thing to do.
Excellent. Great way to kick off our conversation, Arup. Now, you've been in the space for over 3 decades. You're clearly a veteran with quantitative investing, but some listeners might just be getting started in their approach, or at least getting familiar with this approach. One hurdle they might be overcoming is quant was once closely associated with black box strategies utilized by hedge funds. I know that's not what quant investing is today, but how would you help these members of our audience understand the approach and also appreciate the role of governance and oversight in the approach?
So the GQE team, which is the one I lead, is I think gets a lot of credit, especially in the institutional world, which has known quant for a long time about our transparency. As I like to say, if the client knows more about our process, they're likely to stick with me even when I have some tough times in terms of alpha and so on. So I've always been a big believer in as much transparency as possible. As I said in the earlier questions answer, that many or most of the things we look at are just much more disciplined way of what a fundamental analyst looks at. We look at all the same things. If you came to our offices, you'd see that when I'm picking a stock, as I was doing this morning, a model suggested a buy. There's a human element. This is what you're asking about, Rajan. There's a human component to a process where the model suggests These are the buys today for the global equity fund, and these are the sells. Someone like me sectorally looks at the buys and sells and makes sure the reason the model is saying it is right. Is the valuation support is less now because the price has gone up. That makes sense, etc., etc. We look into all those aspects, make sure we're not missing anything, and then we go out and trade in the markets. So this part, what we call the human vetting part of our portfolio management process, is very akin to what any fundamental manager does, except we are helped to a great degree by the computing models. The models take us most of the way. They tell us exactly how to weight different metrics and how to put it in your process. Lastly, I would say whenever you look at managers, you're looking to see if they're a value manager, a growth manager, or a quality manager, or a core manager. In that sense, we are no different. We try to be as much as possible an all weather core manager, which to me implies that our goal is to hopefully beat markets independent of market environment. I would say that definition of core should not be any different from me as for a very fundamental core manager who does not use as much quant in the process. You see the similarities here. We are very similar. It's just that we are far more disciplined. With the computing power, we can cover much more stocks, tens of thousands of stocks in the world, where many of those stocks which are less covered gives us an additional alpha opportunity. Less covered stocks is usually better alpha opportunity. That's the key quant strength. But at a high level, what all we have is not that different from a fundamental manager. So we try our best to show if people come to our offices, these are the valuation metrics we're looking at. These are the growth metrics. These are the quality metrics, in what proportion, and so on, to give our clients lots of confidence that yes, you're a quant manager, but we are not. Again, I repeat, we are not a black box quant manager.
Exceptional answer. I really appreciate your insights and the focus on detail with regards to the transparency on the process of Roop. Thank you. Certainly the furthest thing from a black box. One word you used multiple times in your answer to my prior question was discipline. How does this disciplined approach to investing help when you're building exposure to international developed markets, a space that a growing number of investors are looking to get higher allocations and exposure to?
I've been doing international developed markets since my first decade in the business. At that point, I used to have European strategies or Japanese strategies, not specifically EFI strategies, but those are large components of international. So, given my past background being alive in all those markets, we knew how to build our international developed market products. We call it our international large cap strategy. So, towards that, given our past background, and I've done this with the same team in my past job, we knew that as we launched here, that we needed about a year to build our best Japan stock picking model, best European stocks picking model, our best Australasia ex Japan stock picking model, where we hone in our all weather core process to which value metrics are better favored for Japan versus Australia versus Europe. So that was a lot of research we did, about a 1 year's worth of research. And then we also paired it up with, we have separate risk models everywhere. International has its own risk model, like emerging markets has its own and US has its own. Same with transaction cost model, which predict round trip transaction cost before we make a decision. All of those we took about a year to build before we launched our institutional versions of these products in the summer of 19. So that's 6.5 years back. So we knew that the overall philosophy remains the same wherever we go, whether it is Canada focused or EM or anywhere else. But in international developed, we knew we had to build models separately for Japan than rest of Asia. Japan is a different beast. Value works better in Japan, etc., etc. We knew that going in. And so doing all that, we built as good a process as possible before we got institutional clients, former clients of ours, to give us money to go live in those strategies. So I would say the international developed strategy is as honed into its markets as the US is to its market, Canada it's to its markets. That's the beauty of quant. Same overall philosophy, but then you tune it, as I like to say, for each markets. And as I said, there are three stock selection models that drive our international developed market products: Australasia, ex Japan, and Europe. And that's our main kernel on how we pick stocks there. And we have been doing this live here at McKinsey since the summer of 19 and elsewhere before this for another couple of decades prior to that.
Very good. And again, exceptional detail with regards to international developed markets investing. You made reference, Arup, to emerging markets. I'll take our conversation in that direction now. In our prior conversations, you've shared with me that emerging markets are certainly ripe for alpha capture. Two-part question. Remind our audience why that is true, that emerging markets are ripe for alpha capture. Second part of the question, share why a quantitative approach to investing could be particularly well suited to capturing that alpha opportunity.
I'll go into that, but before I go there, Rajan, I'd also say another theme I've been playing out that is the beta case for emerging markets. That these are very attractive markets are nicely playing out for us for the last 15, 16 months. People forget that these were markets which were not loved by many investors because the beta wasn't there, even if you were able to beat the markets. Obviously, that's been a very different story the last 15, 16 months. That huge value opportunity in emerging markets is a little bit less so, but still it's a very cheap market. But your questions was more about why emerging markets for active management and why for quant. Firstly, I think every manager who's been in the business for a long time would agree with me that emerging markets are less efficient markets. That's why even in most institutional portfolios, even if they go passive in certain areas, it's rare that people are passive in emerging markets because they believe that managers can add alpha there. This is ripe for alpha. So that's the first one. I would say in all the buckets you have, emerging markets is perhaps the least penetrated by indexing, and for a right reason. It's easier to deliver alpha in emerging markets. And that's why I would say you should look at active managers in emerging markets. On top of that, the quant approach in emerging markets comes very, very handy. Is because of the breadth of names. It's not like a not small index, but index with lot fewer weight. The MSCI EM index itself, the standard index, has 1,000 to 1,500 names in it. That's a lot of names to cover. That's where the quant process is very powerful. Quant is we don't go as deep on any stock, but the breadth is enormous for us. As I said early on, we covered 30,000 stocks. When I say cover, we rank them on a daily basis, about 10,000 in emerging markets. And so any of those names, if you find highly ranked at any point in time, can make it to our McKinsey Emerging Markets Fund. That's the beauty of quant, a lot more breadth we can cover, a lot more names we can cover. The diversity of emerging markets, the number of names plays into our strength. One last thing, the four large countries in emerging markets index today, MSCI EM, are all Asian countries, China, India, South Korea, and Taiwan. The common theme in all those countries is they are all very deep market in terms of number of names. That plays into a quant strength. There's a lot of names you can rank. And as I said, we don't go as deep, but we go very broad. Those play into our strengths. I would say those markets or those countries have usually been very, very ripe for disciplined quantitative stock picking. And for those reasons, I would say that firstly, the active case for all managers, and on top of that, the special case for quants, I think is what makes, in my view, our McKinsey Emerging Markets Fund a very attractive fund.
Very good. Thank you, Arup. Now, in our last conversation, which was late in 2025, ahead of our release of the 2026 outlook in our conversation, you shared that the team had implemented a value tilt last year. Certainly seemed to work as we enter 2026. Again, two-part question. I'm kind of curious if you recall, what were you seeing in the data at the time, and how has that actually played out as we approach the end of Q1 2026?
I'm glad you asked that question, Rajan, because to me, we are a very disciplined quant manager, but we also know that the markets are different every day. And therefore, if there's another big opportunity that you can take advantage of, why not do it using a very disciplined process, which is ours? So this is something what you're asking about is we had put on an extra in our process everywhere. We have a fair amount of value, fair amount of growth, and fair amount of quality. That's for all of our strategies, all of the funds we manage. And so when I say we put on an extra value tilt, we added to that, we put some extra emphasis on value starting middle of last year, where we saw in my career, which is, as I said, is in its 34th year, perhaps the largest value opportunity in certain markets, specifically US or global developed. So in those models, as I said, in our international developed, we have three models. Those were unaffected by this. But in strategies of ours, which have US exposure, specifically global equity or our US strategies and so on, Canada focused, we actually increased our exposure, or in other words, we started looking at value, give it a bit more emphasis in our decision making at the expense of growth and quality, because the valuation disparity out there at that point, summer of last year, and quants always like to use this sigma term, was at 3.5 sigma level, which is you don't hit those levels. 3.5 sigma is a very big outlier if you look at data over a long period of time. And it was a 3.5 sigma event for us, higher than the value opportunity was in the height of the pandemic, the internet bubble, and the GFC. What do I mean? The opportunity was this: the valuation spread disparity amongst peers was at its highest I have seen in my career in the US large cap market. We knew that this could only go one way at some point, that the disparity will close, leading to excessive value opportunity. And today, as we sit, the 3.5 sigma value opportunity has started to work for the last many months, starting in Q4, and has now come down some. Still a big opportunity, but not as much. So, the call we made last year about putting some extra value emphasis in our process for US stocks is really nicely playing out for us. And it's also one of the reasons, Rajan, why, as the market may have shifted this year away from the tech and communication services focus and more towards the consumer staples utilities. So far, I know it's a short few couple of months, we have been handling it very well, as in we have been delivering alpha. And we hope to continue that. And I would give one of the reason we are handling it well this year in what many would call a rotation from one theme to another is the extra value emphasis we have in place.
Very good, Arup. I think this is the right time for me to draw on another question that's been in the back of my mind for a while. You're talking about the opportunity that you saw in value in US, the value factor. When you make a positioning shift like this in the portfolio, how do you and the team determine what's the appropriate size and how do you manage the risks with regards to that positioning?
So all of those tie into, we are very measured in terms of, even when we believe this is the biggest value opportunity of my career, I'm not going to become 100% value and totally ignore growth quality of stocks as I pick stocks. That's not our approach, because our approach is all weather core. We are just tilting our emphasis a little bit. I mean, not doubling or something, but by a little bit towards value at the expense of growth and quality. And again, what if you're too early? Then, if you had put all your eggs in one basket, as in only emphasizing value in your stock picking, while that keeps going against you, you'll be wiped out in terms of your alpha delivery. So that's why we do these in measured ways, Rajan. Whenever we add this extra tilts, we do it in two or three small increments, and then we take it off. And we haven't started doing that yet because the value opportunity still is pretty significant, though less so than about 6 7 months back. We take it off in increments.
Very good. My final question for you, Arup, just goes again to the portfolio management discipline. Probably brings in the use of both the models as well as the human oversight. When a factor underperforms for an extended period of time, what gives the team conviction to stay disciplined? Or you could also tackle that question by letting me know, how does the team maybe reconsider that factor if it has underperformed for a period of time? How would you just tackle that situation?
Obviously, no one likes any part of your process to not do well, but that's just the nature of the environment or the markets, the job we do. So to me, just underperformance alone doesn't lead me. I mean, I'm not happy about it, but because our process, Rajan, is built on long term efficacy of a signal. We look at how effective has this signal been in the last many decades. Now, we take into account the recent decades or the recent years more than the past. So, therefore, if a metric is starting to not do as well, we will start lowering our emphasis on that over a certain period of time, because that's how our discipline is. We try to have in our process the perfect weighting on metrics based on how they would have performed in the last 3 decades or so. So obviously, it's a slow moving thing. I would say it also depends on which signal. I mean, value starts to underperform, Rajan. You could have run away from it, but we did the opposite last summer, because whenever the valuation disparity gets wider, means value hasn't really been much of a factor for you in the positive sense. In that case, you saw we doubled down because we thought, my view on value is when the stretch becomes too much, as in the valuation disparity. That's usually after when value has struggled. At some point, it snaps back as it has the last few months. So it depends on the signal to some part, Rajan. So something like value based on underperformance, we will never really take it off, but we'll be monitoring the situation. And whereas if it is a more not as big a super factor, but something on a smaller scale, and if you see that something's performing less well, that could be an efficiency argument that is, it's been arbitraged away and you shouldn't be using that signal anymore. But it all comes down in the end to numbers and a long look back and then a discussion we do as a team, because in all of these, the human element plays a role.
This has been fabulous, Arup. We are at the end of our time together. I have very much enjoyed our conversation, and I'm sure our listeners have as well. Thank you again for making the time to join us on the podcast today.
Thank you always for having me. Nice talking to you, Rajan.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.